Palantir Q4 had amazing results, but the stock tanked anyway. I'm going to explain why and what to do next. Let's talk about what happened after earnings. Besides Netflix and Meta's earnings plunge, this is the third most shocking thing to happen in my portfolio. I haven't seen a mess like this since Putin put 190,000 troops in Ukraine only to withdraw some the next day. We all know the Ukraine and Russian situation is weighing on the market. Q4 financials on the earnings call numbers are impressive, and yet the stock tanked, and that's because Palantir reported adjusted quarterly profit of 2 cents per share that compared to a consensus estimate of 4 cents. But let's ignore that the company went from 750 million to 1.5 billion in the past 2 years. I'm being sarcastic because the market doesn't understand Palantir, just like they didn't understand Tesla. For my subscribers that are long-term investors, I find this situation a buying opportunity. I have no clue when the stock will recover in the short term, but the picture is clear in the long term. I'm going to show you some options and some option strategies in just a second. But on the company's earnings call, CEO Alex Carr pointed to 2.3 billion in cash and cash equivalents that Palantir has on its balance sheet, plus no debt as an example of how it is built for bad times. Not only does it have plenty of cash on its books, but the company also generated 333.9 million in cash from its day-to-day operating activities over the past 12 months. That's why I literally don't care what earnings calls are for Palantir, because at this stage, it's only about the top line and having enough cash to survive the bad times. I have bad times in trading too, but I always hedge my portfolio with different positions and sell call options for income. If you want to know how I'm doing that, I'm going to pin a covered call video in the description. You have to go back to about November 2020 for the last time that Palantir stock was trading much lower than where it is today. And since then, the business has grown, acquired more customers, and furthered its position in the analytics megatrend. The company reaffirmed its annual revenue growth target of at least 30% until 2025 today. This suggests that things are still going according to plan for the business. I also believe PLTR stock pulled back because of the general market. Friday, the entire stock market took a beating, and I mean everything was red. Stocks like Tesla were down, Nvidia down, Nvidia was down like 7.5%, AMD down 3%. All of the high growth names took a beating. So to me, this also looks like the macroeconomic environment dragging down quality companies. I say Palantir is a quality company. In fact, in the software/tech sector, I think that Palantir is more like a waste management type of company. It's essentially an essential service rather than a high flyer stock like the unicorns with no cash flow at all. Palantir is a long-term investment that will likely beat inflation. Also, for the last 3 days, ARK sold 18 million shares of Palantir stock. Imagine how many more investors just copy ARK's moves. This is a significantly large additional selling pressure. I think we should actually thank Cathie Wood for the price because she is spooking the market. Now, because this stock is looking cheap but still has risk, I want to show you the option chain and discuss different strategies that you can use on Palantir with options. All right, let's take a look at Palantir stock. Currently, it's sitting at $10.92. And I mean, this stock is down 49.44% over the last 3 months. And in the past year, it's down almost 60%. Yikes. I mean, this stock was trading at $26. In fact, $27 last year. Now the stock is sitting at a 52-week low at $10.92. I'm going to click Palantir options. I'm going to show you a few different strategies that I would be running today. Okay, today's President's Day and the market is closed, but if the market was open, this is what I would be doing. If you're watching this in the future, you can still learn so much here, because anytime a stock sells off, this is essentially what I'm looking to do using options. Okay, the first and most simplest, and this is really good because Palantir is only $10.92, which is a covered call. Because a covered call requires you to buy 100 shares, this is actually not that expensive, because if you buy 100 shares of Palantir at $10.92, that's $1,092. Now, because you own 100 shares, now you can sell covered call options and collect income. Now, on February 25th expiration, the 11 strike has $53 worth of premium, which is a very high amount. In fact, this is almost 5%. What's awesome is this 5% comes in just 4 days of trading. Now, the break-even price right here is $11.53. So essentially, you're buying the stock for $10.92 and creating an exit point at $11.53 should Palantir close above $11 by February 25th. 25th. But also you can go out into the future. So say you want to do a quarterly call or even a leap. Let's first of all look at a quarterly call. So in 3 months, it's going to be May 20th right here. Let's see, if you bought 100 shares, you can sell, the 11 call option, but I do recommend if you're going out 3 months, you want to give yourself a little bit of room to see some appreciation in the stock itself. If you sell the 11 call option, the 11 strike, you only give yourself 8 cents or $8 for the stock to rise before you have to get rid of it at $11. However, because Palantir has sold off so much, it could bounce back up and you could see a profit. But if you sold $11, you cannot keep anything above $11 besides $11 and this premium right here. So instead, if you're going to sell a 3-month option, I would recommend going a little bit more out of the money. Now for me, if I'm going for an income strategy and if you want to make a lot of income, then you want to go a little bit higher, but not too high, because the 12 strike has $127. However, the 14 strike has $70. So if I were to sell the $12 strike, this would be $127. Now $127 in relation to how much you have to pay to buy 100 shares is over 10%. That means you're making about, let's say, 12% in 3 months. And in a full calendar year, if you were to do this 4 times, then 12% times 4, you would make a 48% return, or when you factor in compounding, you would make over 50% a year. Now, I don't know about you, but Warren Buffett makes about 20% in the long term. So making 50% return a year is insane. That's a really good return to make you rich over time. Now, let's say that you're really bullish on Palantir, which I am, and let's say that you don't really care about income, you care about income plus capital appreciation. Well, in that case, you can even go to something like the $15 strike. Now, if you sell the $15 strike, you'll only collect about $54, which is about 5% return, but now you give yourself so much room for the stock to appreciate. In fact, from 1092, call it $11, up to 15, you can make $400. That 400 is 8 times more than the credit that you're collecting. So you're collecting about 5%, but the capital appreciation is about 40%. Now, for the last call option, I want to show you a leap. A leap is really interesting, and in fact, I think leaps are probably one of the most overpowered things because you collect all the premium up front, you don't have much work to do, and a leap option, whether you're buying it or selling it, I feel like both of them are very advantageous for different reasons. First of all, buying a leap option is very advantageous because theta is very low. When you buy a call option that is very long into the future, it's not really decaying. So you have a similar move to the stock. It's basically a stock replacement strategy. Your leap option is going to rise just like the stock is going to rise in a very similar fashion, maybe almost even a 1-to-1 fashion. And that leap option is a lot cheaper. Now, the reason to sell a leap option if you own the stock is because you're creating a long-term covered call. A long-term covered call is a really overpowered strategy in my opinion, because now you have shares of stock, okay? You can have the stock appreciate and you can sell a longer term call option, say at the $17 strike. The $17 strike, now this is a 50% return. This is a 50% return in 1 year, plus you get to collect all of this premium, $146, which is going to be about a 15% return on top of 50, which is about a 65% return. So you're getting about 65% return for this March 17, 2023 expiration. Now, I do want to show you selling a put option. I have a full video on this that I'm also going to link in the description, but let me show you what selling a put option looks like. So you can go for many different dates. You can go for March 17th if you want to do a leap put option, but I'm going to go out for May 20th. I'm going to do a 3-month put option right here. And the beauty of a put option is you don't have to buy the stock at the current price. In fact, when you sell a put option, you can pick a price that you want to buy the stock for. You're the one in the hot seat. You're the one demanding what you want. You pick the price that you wish to pay. If you don't want to pay it, then you don't have to pay it. You can pick as low as you want. But keep in mind, the lower you go, the lower the premium gets. So say you're like, hey, Palantir is a good stock, but I do not want to buy it for 10 bucks. I want to buy it for like, $7. Fine, sell the $7 put. Or let's say you're really bearish. You're like, hey, I'm only buying Palantir when it's 50% off. I like them Walmart deals, okay? I want 50% off. So if you want 50% off of $11, I mean, that's roughly $5.50. So you can pick the $5 strike or the $6 strike to get exactly what you want. But for me, if I'm looking at Palantir, I think it's already really cheap. So I'm not going to go for the Walmart pricing. I'm just going to go for the Warren Buffett pricing, which is a 15% margin of safety. Okay. So Warren Buffett says he wants a 15% margin of safety. He wants that cushion just in case, because you never know. You never know with the stock market. Okay. You never know with the stock market, right? I mean, I'm not a financial advisor, and Warren Buffett, even when he buys stocks, he looks for margin of safety, because at the end of the day, no YouTuber and no person really knows when to buy a stock at a perfect time, because this is an emotional game. I have a degree in finance. I worked for 2 different hedge funds in Goldman Sachs, and still I've seen a lot of strategies that they try to implement that don't work. So for me, selling put options, doing covered calls, my top 2 favorite strategies. So what I would do is I would sell the $9 put. The $9 put is going for 75 cents. 75 divided by $900, because you're only committing $900 here, is an 8.3% return. I already know that. However, because you're also collecting $75, you don't have to put up 900. You're only putting up 900 minus 75. So this is an $825 trade, and you're collecting 9% in 3 months. If you appreciate this education, leave a like on the video. And as always, in the first link in the description, you can follow all my trades, my buys and sells, and access all my coaching and my option trading academy by submitting your email, watching a free video, and then by booking a free call to learn more about the program if it's for you. And if it's not, no hard feelings. I do this channel because I have a passion for teaching other people option trading. Thanks, and I'll see you in the next one.